Over the last 2 days, silver dropped almost 40%. Gold fell by more than $1,000. And suddenly everyone is asking the same question. What just happened? Was this manipulation? Was something broken? Or did the silver story change overnight? Let's slow this down because when moves are this violent, the answer is usually simpler than it looks. First, let's zoom out. Before the drop, silver had gone vertical. The gold-silver ratio had compressed into the low 40s, levels we almost never see. That alone tells you positioning was extreme, crowded, leverage was high. And when markets get stretched like that, they don't need bad news to fall. They just need pressure. Now let's look at what actually triggered that pressure. This is Friday's COMEX data. Look at the volume first. Nearly 370,000 silver contracts traded in a single day. That's huge. Now look at open interest. Instead of rising, it fell by over 8,000 contracts. High volume plus falling open interest tells you something very specific. This wasn't fresh short selling. This wasn't new conviction. This was positions being forced out. Longs were liquidated, stops were hit, margins were called. This is what a leverage flush looks like. But let's go one level deeper. Most of that activity came from the March contract. That matters because March is the big delivery month. And we are now stepping into February, the final stretch before first notice day on February 27th. As delivery approaches, leverage becomes dangerous. Brokers tighten margins, risk desks get nervous. Weak hands don't get a choice, they get closed. So when price started slipping, the structure did the rest. This wasn't panic selling, but it was mechanical selling. So here's the key question everyone asks next. If silver crashed this hard, did physical silver suddenly flood the market? Now let's check the CME depository data. First, notice the dates. This is December to January comparison, not a 2-day change, but a 2-month delta. Now look at the numbers. Registered silver, the metal actually available for delivery, did not spike higher. Eligible silver moved around, but that's normal. Total combined inventory declined modestly over 8 weeks. Nothing here explains a 40% price move in 48 hours. If physical silver caused this crash, you would suddenly see a surge in registered stocks, but we don't see that. So let's be very clear about what this was and what it wasn't. This was not a collapse in physical demand. This was not a supply shock. This was not the silver story breaking. This was a financial event, not a physical one. And that distinction matters a lot. When markets are driven by leverage, they move fast in both directions. Upside gets exaggerated and downside can get violent. That's exactly what we just saw. Once the weak hands are flushed out, price doesn't need to keep falling. But it does need time to stabilize. Now zoom out again and ask yourself one simple question. Did anything structural change in the last 2 days? Did governments fix their debt problems? Did bond yields suddenly calm down? Did central banks stop buying gold? Did industrial demand for silver disappear? If the answer is no, then what changed was just positioning. And that's why moments like this are confusing for investors, but familiar to traders. For traders, every 5-minute candle matters. They can go long, they can go short. Volatility is an opportunity. But for investors, the question is different. You don't need to predict the next $10 move. You need to understand why the market is behaving the way it is. And right now, the message is simple. Silver is entering its most sensitive window of the year. February is all about positioning. March is all about delivery. That means volatility is not a surprise, but it's a feature. So if you're watching silver over the next 4 weeks, don't focus on headlines, watch structure, watch open interest, Watch how price reacts near delivery pressure. Because when markets stop being emotional and start being mechanical, the data always tells the story first. That's what happened here. And that's what we will keep tracking, calmly, clearly, and without the noise. Historically, when a market survives a leverage flush before a delivery window, the next move isn't driven by excitement. It's driven by what's left. That's why March will be watched closely, not for the fireworks, but for confirmation. You're watching MarketVelugu, Light on Markets. If you like this video, please don't forget to like, share, and subscribe. I will see you in another interesting one.